Imagine you wake up one morning, ready to start your day. You check the news on your phone. A headline flashes across the screen. It speaks of a distant dispute between two major nations. You might be tempted to swipe past it. It seems far removed from your daily life. Yet this very news could be an unseen hand, reaching across the globe and touching your savings. The value of your retirement fund, the price of gasoline for your car, even the cost of your groceries can be influenced by events happening thousands of miles away. This is the world we live in today, an interconnected world, a world where geopolitics matters to every single investor. Whether you are managing millions or just starting to save for your future, the world feels complex and unpredictable. You see stock market charts dip into the red. You hear experts talking about risk and volatility. It is natural to feel a sense of unease. This feeling of being a passenger rather than a driver is unsettling. However, this is precisely where the journey from crisis to calm begins. Understanding these forces is the first step toward taking back control. It is about transforming that initial anxiety into informed awareness and then into deliberate, thoughtful action. Geopolitics is a term that may sound intimidating, reserved for academics and diplomats. In reality, it is quite simple. The study of how countries interact on the global stage, geography, politics, economics, and power, alliances, disputes, and the rules that govern trade and security. At its core, geopolitics is the ongoing story of global relationships. It is the grand chess game played by nations, where the board is the world map itself. Each country is a player: geography, resources, population, political system. They make moves based on their interests. Securing access to vital resources, expanding economic influence through trade deals, ensuring national security. Countries interact through cooperation, competition, conflict. Geopolitics shapes international policies, trade flows, regional stability. Think of the world as a complex network. Goods, money, information flow through it every second. Geopolitics sets the rules for those flows. A new trade agreement can open a pathway. A political dispute can block a pathway. Example: control of a critical strait or canal gives a country immense leverage over global shipping. These dynamics have tangible effects that ripple through markets and impact companies you might own. For the everyday investor, geopolitics brings risks and opportunities. A geopolitical event can suddenly change an asset's perceived value. Rising regional tension can make currency and stocks look riskier, prompting selling. Conversely, a diplomatic breakthrough or a pro-business policy change can attract investors and push asset prices up. Watching geopolitics is like watching the weather before you set sail. You can't control wind or waves, but you can adjust your sails and plot a course. Understanding geopolitical trends helps you see the environment your investments operate in. It lets you ask smarter questions. Is this company dependent on a single, politically unstable country? Does my portfolio have exposure to regions benefiting from new trade alliances? This awareness is the foundation of a resilient investment strategy, built to navigate, not just react. One of the most direct ways geopolitics affects your investments is through trade disputes, often called trade wars. Imagine two countries that are major trading partners. One imposes a tariff, a tax, on goods from the other. Suddenly, products like cars, electronics, steel become more expensive. This single action sets off a chain reaction. The country that was hit often retaliates. Retaliation means imposing its own tariffs. Consider a large American technology firm assembling smartphones abroad. A new 25% tariff hits electronics imports. The company can absorb costs, reducing profit margins, or pass costs to consumers by raising prices, risking fewer buyers and lower sales. Either way, financial performance may suffer and the stock price may fall. The ripple effect does not stop with one company. The entire supply chain feels the tremor, screen manufacturer, chip maker, battery supplier. As production slows, smaller suppliers and shippers lose business. The result is a slowdown affecting entire sectors. For an investor, even without owning that firm, your portfolio can be impacted, especially in funds holding many interconnected companies. Recall 2018 to 2019 when the US and China had a big trade dispute. Billions in tariffs created uncertainty across industries, from agriculture to manufacturing. Stock markets became volatile, reacting to every new announcement and tweet. Investors concentrated in supply chain dependent firms felt the hit. Lesson: understanding global exposure is essential. It's critical to assess long-term resilience and risk. Political instability within a country is another major geopolitical risk that can send shockwaves through financial markets. This instability can take many forms: widespread protests that shut down major cities, a sudden change in government through a coup, a contested election leading to civil unrest. When a country's political situation becomes unpredictable, investors become nervous. Capital flees uncertainty and seeks safety. Consider a mining company in a developing nation. A disputed election triggers massive protests. Roads are blockaded, trucks can't reach the port. Capital controls threaten profit repatriation. Fearing shutdown or nationalization, investors rush to sell. The stock plummets and the local currency weakens sharply. Imports get pricier, fueling inflation. Dividends paid in local currency are worth much less when converted back home. A double blow. This is played out across Latin America, Africa, the Middle East. Events like the Arab Spring showed how quickly upheaval spreads. For global investors, geographic diversification is essential. Sanctions are a powerful tool in the geopolitical playbook, used to influence nations without military force. They are financial and trade penalties imposed by one or more countries on another nation, group, or individual, aimed to punish or pressure a government without resorting to military force. Sanctions can range from freezing the assets of specific officials to broad embargoes that prohibit almost all trade. Imagine a coalition imposes strict sanctions on a major energy producer. Supply is removed from the market. When supply falls and demand holds, prices rise, oil and gas can spike. Consumers face higher fuel and heating costs. Businesses see operating costs climb as manufacturing and transportation rely on energy. Unsanctioned energy producers may see profits and stock prices soar, while airlines, trucking, and chemicals face pressure as fuel costs surge. The sanctions imposed on Russia following its invasion of Ukraine in 2022 provide a stark example, targeting the central bank, major financial institutions, and crucial energy exports. Europe saw record energy prices, inflation spiked, multinationals divested and wrote off assets, and supply chains were reshaped, forcing a reevaluation of geopolitical risk even in blue-chip stocks. Section 6. Military conflicts and market tremors. Of all geopolitical events, military conflicts, even the threat of war, have the most immediate, dramatic impact on markets. Conflict creates the ultimate uncertainty. It disrupts lives. It destroys infrastructure. It brings normal economic activity to a halt. Investors flee risk assets like stocks and move into safe havens. Gold, the US dollar, and stable government bonds. Airlines and tourism are hit hard. Defense firms can rise. Commodity supply can be disrupted, sending agricultural prices higher. Initial moves are emotional, but long-term impact depends on duration, scale, and location. Prolonged wars can drive high inflation, large debts, and redraw trade and energy maps. Do not make panicked decisions in the initial chaos. Assess long-term implications and ensure your portfolio is resilient. Section 7. Example 5. Elections, policies, and economic shifts. Elections regularly shift taxation, regulation, government spending, and trade policy. Markets can be volatile into a close race. then move sharply once results are clear. If a pro-business party wins, expect a market rally, with financials and energy boosted. If higher taxes and stricter rules win, tech and pharma may lag while renewables benefit. We see this in the US, Germany, Japan. Traders price polls and debates, but for long-term investors, don't try to time the market on predictions. Instead, be aware of policy shifts and ensure broad sector diversification to cushion single policy shocks. Section 8. A framework for protection. 4 actions for every investor. Knowing the risks is the first step. Taking action is the second. You don't need complex strategies. Fundamental principles applied consistently work. First, diversify globally. Don't put all your eggs in one company, one industry, or one country. Use low-cost global index funds or ETFs to reduce vulnerability. Second, stay informed, but not inundated. Choose a few balanced sources and check in periodically. Identify long-term shifts, not every headline. Panicked selling is almost always a losing strategy. Have a plan before a crisis, and stick to it to avoid emotional decisions. Third, strategically allocate to safe haven assets. A modest allocation to gold, high-quality government bonds, and some cash can cushion portfolio declines and provide dry powder. Finally, understand and use simple hedging. Currency-hedged international funds can help if foreign currencies weaken. For most, robust diversification across stocks, bonds, commodities, and geographies is the best hedge. Section 9. Conclusion. Navigating the future with calm and confidence. The world will always be complex. Trade negotiations, political transitions, regional conflicts will ebb and flow. Your money will be exposed to these forces. This isn't a reason for fear. It's a foundation for strength. Trade wars, political instability, sanctions, military conflicts, and elections ripple through stocks, currencies, and commodities. A tariff can squeeze profits. A protest can halt a supply chain. An election can reprice an industry. These aren't worries. They're case studies that give you foresight. You are in control. Build a resilient, durable foundation with 4 key actions. Diversify globally. Stay calmly informed. Hold safe haven assets. Use simple hedging. You're not trying to outsmart geopolitics. You're designing a portfolio to endure it, so you can focus on long-term goals: a comfortable retirement, a child's education, financial independence. As you look toward 2025 and beyond, do not let complexity paralyze you. Embrace it. Navigate with a good map and a steady hand. The prudent investor prepares. Take simple steps today. Build a diversified, balanced portfolio. Make a plan and stick to it. By doing so, you transform uncertainty into a manageable variable. You can build a safe harbor for your savings and navigate the world's challenges with calm and confidence. Thanks for watching. Like, subscribe, and hit the bell for more insights on investing and finance.